say this iron ore, this coal mine is dedicated to only China, well, the other miners will have to find a market, and those products from those other mines will find their way to India.
Today, China holds over $1 trillion of U.S. treasuries. And that poses a risk for the U.S. if China withdraws from these. Does that worry you?
No, actually it might be a very good thing if the Chinese withdrew a little bit from the U.S. Treasury market, and then it would force the U.S. to put their house in order. I don't see that happening anytime soon, but I do see the Chinese diversifying their foreign exchange reserves. From what we've seen, it seems that they have been not buying as many of these U.S. treasuries as they have done in the past, and they've been diversifying into direct investments in various countries, other foreign currency investments, and so forth.
What, in your view, is the biggest risk for China's growth? Is it the banking system? Is it policy making? Is it political change? Is it labor unrest, or something else?
Yeah, I would say right now it's political. They have to get to grasp with what the aspirations of the population are. It's a changing situation. There's a vast young population that are educated, and the political system has to adjust to this change and be receptive to new ideas and new concepts. So I would say that's the biggest challenge facing the Chinese now.
Mark, a final question. For the long-term investor, would you overweight India or China?
For the long term, probably India. But again, it depends on the individual stocks. I mean, we are stock pickers, and we want to find cheap stocks. At this stage of the game, China has more cheap stocks than India because they've been issuing a lot of new paper, new shares. But over the long term, probably India.
Well, Mark, thank you very much for joining us. We're going into a short break now. Adrian Mowat of JP Morgan Chase joins us on the other side, so stay with us. Welcome back. You're watching Global Insights with me, Punita Kumar Sinha, and we're talking to Adrian Mowat, Chief Asia and Emerging Market Strategist of JP Morgan Chase. Adrian, you've talked about China having a hard landing. We just spoke to Mark Mobius, who thinks China is recovering. Why do you think China is facing a hard landing, and will the Chinese economy ever be able to go back to the 10% growth rate?
Yes, I was quoted as saying that China is in a hard landing, but let's be specific about the quote. I was saying that if you were involved in residential construction, which was down year over year, if you were selling excavators, diggers, etc., which are down 25% year over year, so there's parts of the Chinese economy that are already contracting, and the leading indicators are not good. If China, I think, is at a very early stage of a slowdown, it's a structural slowdown reflecting three very important inflection points. The first is demographics. The working age population in China has peaked, but particularly the working population that goes into manufacturing, into construction. So that's the youths without a tertiary education. That is already declining at something like 4% per annum. Second inflection point is excessive investment in 2009 because of the extremely high growth rate that we had in 2009. And now as we go into 2013, we're seeing operating rates falling, profitability falling, which means that CapEx will fall. And so that's the second inflection point, overinvestment back in 2009. The third inflection point is back to the property market. Property prices peaked in June last year. So there are three inflection points, which gives you a much lower level of trend GDP growth in China. It may be a healthier form of growth. It may be ultimately a slightly more profitable form of growth for the equity investor. But the next couple of years will be reasonably uncertain and quite difficult ones for equity investors in China. And this is why the Shanghai Composite Index is one of the poorest performing indices globally. It looks as if it might even drop below the 2000 level, which would be below its 2009 lows.
Given these issues in China, can you actually see India growing faster than China?
I actually think India is probably already growing faster than China is at this point in time. But it's very important, you know, when people talk about GDP statistics, we publish GDP numbers very rapidly in China, relatively rapidly in India. They're merely a sample of what's going on within the economy. They may understate, they may overstate what's actually going on. But if I look at this from the perspective of an equity investor, I'm seeing a better trend in earnings in India than I am in China. And ultimately, that's how I make money in the market, is through participating in the growth in earnings, not necessarily through participating in the official GDP statistic.
The slowdown in China is likely to impact commodity prices worldwide, and that should help earnings of companies, especially in India. Do you think that this benefit is going to be just a short-term benefit, or is it going to be a structural longer-term benefit?
Yes, I think India gets two benefits from that. One is, as you highlight, raw material costs fall, which could be good for margins for the manufacturing sector. The other should be a decline in the current account deficit in India, which would reduce India's risk premium if its import bill for commodities and energy declines.
Now, Adrian, I've rarely seen the Chinese market outperform Indian stock market. Even over longer periods of time, China has been an underperformer. So despite strong economic growth, why do you think the Chinese market has been such an underperformer versus the Indian stock market?
It's very important to look at the stock market composition rather than just talk about the economy. So 75% of market cap in China is state-owned enterprises. So as a minority investor, your interests may not be the same as the majority investor or the government. At this point in time, we're seeing a decline in net interest margins for the banks. This is probably the right macroeconomic policy from the perspective of the government, but it's bad for me as a minority shareholder. When I look at the Indian stock market, it's only 12% PSUs. So it's more likely that the management of that company interest is more aligned with me as a minority investor. I always think that India grows despite its government, and that the private sector has grown up having to deal with all the structural problems in India of poor infrastructure, high cost of capital. But that's made it a more successful industrial base because it's grown up through adversity, which makes it stronger.
Would you advise your clients to be overweight India or China over the next few years?
Well, let me comment on our current recommendations. We're currently overweight India and we're underweight China. So I'm underweight China because it's having a profits hard landing. And I'm overweight India because I think India will hopefully see some more stories on reform as people take seriously this threat of a downgrade to junk status by the major rating agencies. I also think that India is going to accelerate from the lowest level of growth that we've seen since 2003. The acceleration is for the cyclical factors of lower repo rates, but also a very competitive currency.
Thank you, Adrian.
Pleasure.
There may be mixed opinions of China, but both our guests are clearly favoring India. Let's now speak to Tanveer Gill and see what the financial analysts are forecasting. Tanveer, what is the data showing from financial analysts on the forecast for China's growth?
Well, Punita, talking about China's growth, I mean, there is an expectation that going forward we will be looking at growth recovering a bit in 2013, as is the expectation with India as well, that in FY14 there could be a bit of a pickup in growth. The estimates are suggesting that the Chinese growth, and this is on a consensus basis, will be about 8% roughly for 2012 end, and about 8.3% for 2013 end. For India, FY13, the average and the RBI target was also about 6.5%. The consensus is showing about a little lower than that, 6.15%. And for 2013, it is expected to pick up a bit. But again, it's not conclusive. These are just trends and extrapolations that are out on the street. Inflation will not be a concern for China, and that's been the much talked about issue, where inflation in India, of course, has been very sticky and will continue to be a reason for worry going forward. What is interesting is I just drew up some analysis on the basis of historical data correlating stock market returns to growth that both these markets and economies have seen, and whether it's the Shanghai Composite versus the Nifty or the MSCI China versus MSCI India. Despite high growth rate in China, we're not really looking at the market really doing much there. It's been a ranked underperformer to India. And that brings me to my question to you, Punita. How are you looking at the structural story in China, and what does it mean for India?
Now, in terms of how China's slowdown can impact India, I think actually there are many ways in which India benefits from Chinese economy slowing down. The first one obviously is that would mean lower commodity prices in the short term. That would help earnings of Indian companies. The second one is as wage costs are going up in China, the manufacturing sector might become uncompetitive relative to India, and that could give India an opportunity to invest in its manufacturing sector and potentially increase exports. Of course, there are lots of Indian companies that import goods from China and then sell them in India, and they have, a lot of equipment coming from there, and those would be negatively impacted as the Chinese wage costs go up. But of course, there is a possibility that China could devalue its currency, and then of course the whole equation goes back to where it is almost today. And then of course, as the whole world is slowing, I think one area that India needs to focus on, and perhaps even China, is increased trade between the two countries. And I think that's a trend that we hope will increase in the future.
So from a market perspective, and given your years of experience in managing funds, how are you looking at allocations between India and China?
So, interesting question. First of all, I think most people have tactically moved to an overweight on India just in the last couple of months, as there was hope that finally, again, with the change in the finance ministry, that there may be some more reforms that will happen. And China hasn't seen, most people are still underweight on China. In fact, if you look at the fund flow data that you talked about, it appears to me that India has got significantly more flows than China. In fact, some numbers are indicating China's actually had an outflow. Now, going forward, this might change if we see positive data coming out of China. Chinese valuations today are factoring in a lot of bad news. If you look at what China is trading at, it's trading at a multiple about 8 to 9 times. Sure. India is trading at a multiple of 12 to 13 times. You're right, the Chinese profitability in terms of the company's earnings is worse than India. India's, at the moment, the estimates are about for 14%. In China's about 7-8%. But I think what we are not seeing are people are not factoring in any uptick potentially coming in the Chinese economy. And if we see any positive news flow, I think the valuations are more than discounting a lot of this bad news. So I think the potential for China to outperform from here is a possibility, is a real possibility. And of course, if India disappoints on the reform front, we might see people sort of going back and putting some money from India to China. That's my view. With that, we wrap up this edition of Global Insights. Do join us next week to discuss whether the BRICS markets are going to be losing their winning edge or not. Thank you very much for joining.